A term sheet is a non-binding agreement that outlines the key terms of an investment before a formal contract is signed. It serves as the blueprint for how a venture capital deal is structured, defining the rights and responsibilities of both investors and founders. For VCs, negotiating a term sheet is one of the most important moments in their fundraising journey. Each term affects ownership, control, and financial outcomes. This is why understanding the details is critical to making informed decisions. Below are the key terms commonly found in a term sheet and how they shape the dynamics of an investment. Valuation is a key factor in any venture deal because it determines how much a startup is worth both before and after new capital is invested. The pre-money valuation is the value of the startup before any new investment is added. It reflects the company's current traction, revenue, team, and market potential. The post-money valuation, on the other hand, is the value of the startup after the new investment is included. It's calculated like this. Post-money valuation equals pre-money valuation plus investment amount. So, let's say a startup has a pre-money valuation of $8 million and raises $2 million. The post-money valuation would be $10 million. Why does this matter? The post-money valuation determines the investor's ownership stake. If an investor puts in $2 million at a $10 million post-money valuation, they now own 20% of the company, $2 million divided by $10 million. Understanding these numbers is crucial for both founders and investors when figuring out equity splits and ownership percentages. The equity split is a critical element of any investment deal because it defines ownership structure once the investment has been completed. Understanding how equity is divided helps all parties align expectations and assess their position in the company going forward. Founders' equity refers to the portion of ownership that the founders retain after the investment. It reflects their continued stake in the company and their role in driving its future success. Investor equity represents the percentage allocated to new investors based on the capital they contribute. This amount is determined by the post-money valuation of the company and the size of the investment being made. The option pool is a portion of equity reserved for future employee stock options. It typically ranges from 10 to 20% and is set aside to help attract and retain key talent as the company continues to grow. Investors often require startups to increase the option pool before investing to ensure that sufficient equity is available to attract and retain top talent without causing further dilution post-investment. This adjustment impacts the founder's ownership percentage, as the expansion of the option pool is typically accounted for before the new investment is allocated. For VCs, structuring the option pool correctly is essential to maintaining a competitive and incentivized team while balancing the overall equity distribution in the deal. A liquidation preference is an important term in venture capital deals because it determines how investors are paid in the event of an exit, such as a sale, merger, or shutdown of the company. A standard 1x liquidation preference means that investors are entitled to receive the amount they originally invested before any remaining proceeds are distributed to other shareholders, including founders and employees. For example, if an investor invested $5 million, they would receive $5 million back first upon exit. Only after this initial amount is returned to the investor are any remaining proceeds distributed among the rest of the shareholders, based on their ownership percentage. The liquidation preference can be either participating or non-participating. In a non-participating scenario, investors have the right to either take back their initial investment or convert their safe or preferred shares into common equity and share in the proceeds, whichever option gives them the higher return. They cannot do both. In contrast, a participating preference, sometimes referred to as a double dip, allows investors to first get their original investment back and then also receive a pro rata share of the remaining proceeds. While this structure favors investors, it tends to be less favorable for founders, as it reduces the amount available to common shareholders in the event of a sale or merger. For example, let's say a startup is sold for $50 million and an investor had invested $5 million for 25% ownership with a 1x liquidation preference. Under a non-participating preference, the investor would choose between receiving $5 million, the amount invested, or 25% of the total exit amount, $12.5 million. In this case, they would obviously choose the higher amount, which is $12.5 million. Under a participating preference, the investor would first receive their $5 million back and then also receive 25% of the remaining $45 million, which is $11.25 million. The total payout would therefore be $16.25 million. Why does this matter? For investors, liquidation preferences serve as a key risk mitigation tool, ensuring they recover their capital before proceeds are distributed to other shareholders. This is especially important in scenarios where the exit valuation is lower than expected. The specific structure of the liquidation preference, whether participating or non-participating, can significantly impact overall returns and should be carefully negotiated to align with the fund's investment strategy. Understanding how liquidation preferences affect the payout structure allows VCs to optimize deal terms while balancing the interests of both investors and founders. When a startup raises a future round at a lower valuation than the previous round, known as a down round, early investors can see their ownership stake significantly diluted. To protect themselves, investors often include anti-dilution provisions in the deal. These provisions adjust their conversion price so that their ownership isn't unfairly reduced. There are two main types of anti-dilution protection: full ratchet and weighted average. A full ratchet provision is the most protective for investors. If a new investor buys shares at a lower price, the existing investors get the same price, retroactively adjusting their ownership stake. While this helps investors, it can be harsh on the founders since it can lead to significant dilution. The weighted average provision, on the other hand, is more balanced. Instead of matching the lower price like a full ratchet, it recalculates the conversion price for existing investors based on both the lower price of the new round and the number of new shares issued. This means the adjustment considers how much dilution is actually caused by the new round. As a result, existing investors receive some protection. They still face some dilution, but it's proportional, not punitive. The weighted average method reduces the impact on founders and helps maintain fairness between old and new investors, making it a more commonly accepted compromise in venture deals. Why does this matter? For investors, anti-dilution provisions are a critical safeguard to maintain their proportional ownership and protect their investment value in case of a down round. While full ratchet offers the strongest protection, it can strain relationships with founders and deter future investors due to its heavy dilution impact. Weighted average provisions, while still protective, offer a more balanced approach that preserves investor interests while maintaining the startup's long-term viability. Understanding the implications of these provisions helps VCs structure deals that mitigate risk while supporting sustainable company growth. Tag-along and drag-along rights are important provisions that dictate what happens when a major shareholder, usually the founders or lead investors, decides to sell their shares. Tag-along rights are designed to protect minority shareholders. If a majority shareholder decides to sell their shares, tag-along rights allow smaller investors to join the sale under the same terms. This ensures that they're not left behind in a lucrative deal and can sell their shares if the majority decides to. On the flip side, drag-along rights give the majority shareholders the power to compel the minority shareholders to sell their shares if they decide to sell the company. This prevents a situation where a small group of shareholders can block a potential sale or merger, which could be beneficial for the company. Why does this matter? Drag-along rights provide investors with the assurance that an exit can proceed smoothly without minority shareholders blocking a sale, making the company more attractive to potential buyers. Tag-along rights, on the other hand, ensure that smaller investors receive fair treatment in a liquidity event. For VCs, these provisions help align investor interests and facilitate clean exits, ultimately protecting their ability to generate returns. Governance terms are crucial because they define who has the decision-making power within the company, which becomes especially important as startups scale and bring in outside investors. One key element is board seats. Investors often want a seat on the company's board to have oversight on decisions. After a venture capital round, the board structure typically includes founders, usually 1 to 2 seats, investors, that could have 1 to 2 seats, and sometimes an independent board member who acts as a neutral party to provide unbiased guidance. Voting rights also play a big role. They determine who can vote on critical decisions, such as acquisitions, hiring executives, or issuing new shares. Investors may demand veto power over major company decisions to ensure their interests are protected. Why does this matter? Governance terms directly impact investor influence over a startup's strategic direction. VCs seek board representation and voting rights to safeguard their investments and ensure sound decision-making. A well-structured board with a balanced mix of founders, investors, and independent members helps align interests, mitigates risks, and fosters long-term growth. Reserved matters are decisions that require investor consent before they can be carried out. These typically include actions like issuing new shares, which would lead to further dilution, selling the company or merging, taking on significant amounts of debt, or changing executive leadership. Why does this matter? Reserved matters provide investors with a level of control over critical company decisions, ensuring their interests are protected. However, VCs should strike a balance. While these protections help mitigate risks, overly restrictive terms can slow down operations and hinder a startup's ability to pivot or seize opportunities. A well-negotiated agreement ensures investor security while allowing the company to remain agile and responsive. Vesting is designed to ensure that founders and key employees don't walk away with large equity stakes before contributing long-term value to the company. The standard founder vesting terms typically involve a 4-year vesting with a 1-year cliff. This means founders need to stay at least 1 year before earning any equity, and they will fully vest over 4 years. The 1-year cliff ensures that if a founder leaves within the first year, they don't receive any equity at all. There's also acceleration on exit, which means that if the company is acquired, some or all of the unvested equity may vest immediately. This provides protection for founders, ensuring they don't lose out on equity if the company is sold earlier than expected. Why does this matter? Vesting aligns the interests of founders and investors by ensuring long-term commitment to the company. From a VC perspective, structured vesting terms help protect the investment by reducing the risk of key team members leaving prematurely. At the same time, well-balanced acceleration clauses can be beneficial in acquisition scenarios, ensuring that key contributors are fairly compensated while maintaining investor protections. When investors use safes or convertible notes, they often receive a discount when their investment converts into equity in a future funding round. These discounts typically range from 10 to 30%, allowing early investors to buy shares at a lower price than the new investors in the next round. The idea behind the discount is to reward those early investors for taking on more risk by investing before the company has proven itself. Why does this matter? For investors, discounts on safes and convertible notes provide a built-in reward for taking on early-stage risk. A well-structured discount ensures that investors receive favorable terms without overburdening the startup with excessive dilution. From a VC perspective, negotiating the right balance helps maintain strong ownership positions while still making early investments attractive and competitive. Term sheets are critical documents in defining who owns what, who controls what, and who gets paid first in a startup's life cycle. For founders, it's important to carefully negotiate these terms to ensure they retain enough ownership to stay motivated and maintain control over the company's direction. Founders also need to strike a balance with investors, ensuring they don't agree to excessive restrictions that could hinder the company's flexibility. Plus, fair exit terms are essential to allow founders to benefit from the company's success when the time comes. Investors, on the other hand, are focused on maximizing their upside while protecting themselves from downside risk. They want to ensure they have strong protections in place in case things don't go as planned, while still benefiting from the company's potential growth. A well-negotiated term sheet aligns both sides, setting the foundation for a successful partnership. In venture capital, the right terms can determine not just the success of the deal, but also the long-term success of the company. It's about creating a fair and mutually beneficial agreement that supports the startup's growth while safeguarding both founders and investors.